Have you ever wondered which beverage giant, Coca-Cola or PepsiCo, leads in financial performance? Let's dive into the numbers. In the beverage battleground, the total revenues for the year 2023 tell an interesting story. Coca-Cola rolled in a cool $35 billion, while PepsiCo, not to be outdone, clocked in a whopping $64 billion. Digging into these numbers, we find that the revenue sources for these beverage behemoths are as diverse as the flavors they offer. Coca-Cola's earnings come from all over the globe, with 18% pouring in from Europe, the Middle East and Africa, 12% from Latin America, a significant 36% from North America, and the remaining 12% from the Asia-Pacific region. On the other hand, PepsiCo's revenue structure tells a different tale. A significant chunk of 27% comes from Frito-Lay North America, another 31% from PepsiCo Beverages North America, 12% from Latin America, and 14% from Europe. But what does this mean? Well, it's clear that while PepsiCo leads in total revenues, Coca-Cola's revenue sources are more geographically diverse. This shows that Coca-Cola has a broader global presence, while PepsiCo's strength lies in its North American market. So, in the revenue rumble, it's a case of different strokes for different folks. PepsiCo might be the heavyweight in terms of total revenue, but Coca-Cola's diverse geographic revenue distribution shows it's a global player. So, while PepsiCo outperforms Coca-Cola in total revenues, Coca-Cola has a diverse geographic revenue distribution. Now that we've quenched our thirst for revenue, let's sip on some profit figures. It's time to delve into the gross profit margin, net profit, and net profit margin of both Coca-Cola and PepsiCo. Starting with the gross profit margin, we see Coca-Cola bubbling over at 60%, while PepsiCo trails slightly behind at 55%. The gross profit margin gives us insight into a company's financial health, indicating the percentage of revenue that exceeds the cost of goods sold. Higher values naturally mean the company retains more from each dollar of sales to cover operating and other costs, a sign of financial strength. Let's pop the lid on net profit now. Coca-Cola fizzed up to $9 billion in the year 2023, while PepsiCo was not far behind, netting $8 billion. Net profit is the actual profit after working expenses not included in the calculation of gross profit have been paid. It's a key figure for investors, as it represents the amount of total revenue that the company actually keeps. Finally, let's examine the net profit margin. Coca-Cola's net profit margin stands strong at 25%, while PepsiCo's trails behind at 12%. The net profit margin is a key profitability metric for a company. It's calculated by dividing net profit by revenue, then multiplying by 100 to get the percentage. This ratio shows what portion of each dollar of revenue a company keeps as profit after paying all its costs. In summary, Coca-Cola seems to have a sweeter deal with a higher gross profit margin and net profit margin, despite PepsiCo's larger revenue. However, as we know, the financial fizz is not all about profit. In our next segment, we'll be looking at returns and assets to provide a more comprehensive picture of these beverage giants' financial health. Stay tuned and keep those investor taste buds ready for more. Money makes money, as they say. But who does it better in the beverage industry? Let's dive into the numbers and see how Coca-Cola and PepsiCo stack up when it comes to returns and assets. Starting with return on equity, or ROE, Coca-Cola sits at 42%. Now this is a key indicator of financial efficiency, showing us how well a company is using its equity to generate profit. On the other side of the can, PepsiCo outshines Coca-Cola with an ROE of 55%. It appears that PepsiCo is using its equity more efficiently to generate income. But let's not stop there. How about return on assets, or ROA? This is another crucial metric, as it gives us insight into how effectively a company uses its assets to generate earnings. Coca-Cola boasts an ROA of 11.9%, edging out PepsiCo, which stands at 10.4%. This suggests that Coca-Cola might be better at using its assets to generate profit. Now, let's crack open the can on total assets. Total assets are everything a company owns that has value. At the end of the third quarter of 2023, Coca-Cola had total assets of $98 billion, while PepsiCo was slightly ahead with $100 billion. But what about equity, or net assets? This is the value of a company's assets after all debts and liabilities have been paid. Here, Coca-Cola bubbles to the top with $28 billion, while PepsiCo trails with $19 billion. Finally, we have the equity to total assets ratio, which provides a measure of a company's financial leverage. Coca-Cola leads with a ratio of 29%, suggesting a stronger equity position relative to its total assets. PepsiCo, on the other hand, has a ratio of 19%. So what does all this mean? PepsiCo seems to be squeezing more out of its equity, but Coca-Cola manages a higher return on assets and holds a higher equity to total assets ratio. Cash is king in business. Let's see how these beverage behemoths manage their cash flows and operational efficiency. In the world of finance, liquidity is a company's ability to meet its short-term obligations. Two key ratios are used to measure this: the current ratio and the quick ratio. The current ratio is calculated by dividing a company's current assets by its current liabilities. A ratio greater than 1 indicates that a company has more than enough short-term assets to cover its short-term debts. Coca-Cola's current ratio stands at 1.14, while PepsiCo's is 0.88, meaning Coca-Cola is in a better position to cover its short-term obligations. The quick ratio, on the other hand, is a more stringent measure of liquidity. It excludes inventories from current assets before dividing by current liabilities. In this case, Coca-Cola's quick ratio is 0.97, while PepsiCo's is 0.71, again showing that Coca-Cola has a healthier liquidity position. Now let's shift gears and talk about operational efficiency. This is measured by inventory days and accounts receivable days. Inventory days measures the average number of days a company holds its inventory before selling it. Coca-Cola's inventory days is 82, while PepsiCo's is just 51. This indicates that PepsiCo is more efficient at managing and selling its inventory. Accounts receivable days, on the other hand, measures the average number of days it takes a company to collect payment after a sale has been made. Here, Coca-Cola takes the lead with 27 days compared to PepsiCo's 47. Lastly, we have the total assets turnover, which indicates how efficiently a company uses its assets to generate sales. A higher number is generally better, and in this case, PepsiCo outshines Coca-Cola with a turnover of 0.88 compared to Coca-Cola's 0.49. PepsiCo turns over its assets faster and manages its inventories more efficiently, but Coca-Cola has a better liquidity position. Finally, let's pore over the cash flows and dissect the return on equity, or ROE, with the DuPont analysis. When we look at the cash generated by operating activities, Coca-Cola comes in at $9 billion, while PepsiCo generated $8 billion. This metric essentially tells us how much cash a company is generating from its core business operations. Now let's talk about free cash flow. This is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. Coca-Cola has a free cash flow of $8 billion, while PepsiCo's stands at $5 billion. Now, in terms of operating cash flow to net income, both companies stand at a ratio of 1. This ratio gives us insight into the company's ability to turn profits from its income statement into cash. Now, onto the DuPont analysis. This model breaks down the ROE into 3 components: net profit margin, asset turnover ratio, and equity multiplier. It gives us a deeper understanding of a company's financial performance and pinpoints areas where it can improve. For Coca-Cola, their ROE stands at 42%. Their net profit margin is 25%, their asset turnover ratio is 0.49, and their equity multiplier is 3.51. On the other hand, PepsiCo's ROE is 55%. Their net profit margin is 12%. Their asset turnover ratio is 0.88, and their equity multiplier is 5.27. In summary, the DuPont analysis helps us understand how a company is generating its ROE, whether it's through high profit margins, efficient use of assets, or leverage. In the end, both Coca-Cola and PepsiCo have their strengths and weaknesses. But understanding these numbers gives us a clearer picture of their financial health and performance. Remember, this analysis is a snapshot of their performance in 2023. Always do your due diligence and keep up with their latest financials before making any investment decisions.